a lot of people make the mistake of not taking the money when it's available. And your best chance at getting the most amount of money is before you've started the business. You've invested a lot in terms of researching your market. You might have a great business plan, and that's the best time to go out and get an equipment finance loan or a lease.
What are some things to avoid, the mistakes that folks make when they're in that initial period like you described?
There are a few mistakes to make. A lot of companies, and especially if you're inexperienced with lending, you might think that your best option is the bank. And oftentimes the bank is the best option depending on what you want to finance. If you're looking to finance working capital, for instance, if you're carrying a lot of receivables, if you're manufacturing something or if you're reselling something and you have to carry a lot of inventory, absolutely your bank line of credit is the best option because it revolves and it increases and decreases as you need it. If you're buying capital equipment, it might not be the best option for a number of reasons. Number one, because term debt is very capital intensive for banks, and meaning it's expensive for them. The way that most banks work on a risk adjusted return on capital model. They prefer to give you a revolving line of credit where they know it's going to be paid down quickly. And they also prefer to earn their money on fees. They don't necessarily want to have their money for 5 or 6 years in an equipment loan. The second thing is that if it's available, the equipment financing provides an additional source of capital for a business, which is important. Whether you're a small business, medium, large business, managing your treasury is always very important. And you want to make sure that even if the cost of capital is incrementally higher, it might result in a couple of $100 incremental cost per month. It still gives you the availability of the cash that you needed, and then you could keep your bank line of credit open for when you need it for emergencies, or, let's say one of your suppliers offers you a great deal on an inventory, but you have to act quickly and buy it in the next 2 weeks and pay for it immediately. So that's one of the things. The other thing is sometimes borrowers are seduced by a quoted low rate. Right. And a proposal or a quote is not necessarily a commitment. We see it much more often in the States than we do in Canada, but there are a lot of lenders out there, including banks and reputable companies, who quote one deal knowing that that's not a realistic quote. And then they come back, once you've invested a lot of time with them, they'll come back with, well, here are the terms of the committed offer that we're giving you. The other thing is some lenders are unscrupulous. I don't want to scare anybody, but they'll quote a certain rate that's not a true annual percentage rate. It's not an APR. And no matter how much you try and pin them down, if they know that somebody wants to hear that the rate is 5%, even though the rate might be 11 or 12, they'll tell them that. So the best way to avoid that, or to mitigate your risk of getting stuck in a situation like that, is either, there are a lot of calculators online. If you look up present value of money calculator, you can find something on any search engine. Mm-hmm. If you're a little proficient with spreadsheets, you can make your own, and you can calculate your own in Excel. You can go to your accountant who may or may not know how to calculate rates. Oddly enough, and I could say this because I'm a CPA, not all CPAs know how to calculate finance rates, but you might have a friend who's, at a car dealership, a mortgage agent, has the software. They could do it for you. The best way to do it is, if you're getting more than one quote, ask whoever is quoting you, say, I understand you're quoting me a certain rate. Please, this is the payment that I'm looking for, or give me what the payments are going to be with, let's say, a 10% first payment and the remaining payments over 59 months. And sometimes when you compare somebody's 5% rate to somebody else's 11% rate, you're going to find that 11% rate, if it's a true rate, is actually lower than what somebody is telling you is a 5% rate. Okay. The third one is that with startups, a lot of people make the mistake of not taking the money when it's available. And your best chance at getting the most amount of money is before you've started the business. You've invested a lot in terms of researching your market. You might have a great business plan. You've got really good experience in the industry or managing somebody else's company. You might have equity in your house, and that's the best time to go out and get an equipment finance loan or a lease, bank credit, because the next 2 or 3 years you're going to be building your business and your financials will not look quite as good as what the banks want to see or any kind of lender wants to see. So you're much better off taking what's available at the outset rather than waiting a year and a half or 2 years and then looking for money.
Right. When you're in that slugfest where you're not,
Yeah.
turning over.